I want to talk to everyone about the 5 C's of credit. This is essentially a kind of report card that lenders will use to assess how much, if they're willing to lend money to you in the first place, and if so, how much and at what rate. So, in other words, how expensive it is going to be for you to pay back any kind of loan to finance any endeavors where you have to borrow money. And this applies not only to personal finance, if not to corporate finance, at the very least to most small businesses when you're getting a business off the ground, should you decide to do that at some point in your life. So let me share to my Word document. So the 5 C's of credit come down to character, work experience, character, cash flow, capital, conditions, and collateral. So the character aspect, as I've broken it down, can be thought of typically as either work experience and or credit history if you already have a credit history. So work experience, for instance, let's say we have two people, Bob and Jan, and Bob had one job for, let's say, 0 to 5 years, and then that was job number 1, and then job number 2, second job, let's say he's been in that job just about 6 months. Okay. So Jan, however, she had one job for a year and then a second job for another year and then another job for about 6 months. So 1, 2, 3. All right, so a couple things. If you have a better work history, just like if you're trying to get a job, the employer is going to look at how long you've been at previous jobs. Are you someone who's consistent, or do you jump around from job to job? Well, a lender is going to look at the prospect of someone like Jan in an even more detrimental light than an employer often enough, because they're looking at your ability to pay back that loan. And if your stability in the workforce is questionable, their willingness to loan you money is also questionable. Another thing isn't just your longevity with a particular employer, but also the industry in which you work. So, two different scenarios. Let's say Bob worked at a golf course for 5 years, and now he's a school teacher and just got a job as a math teacher. Well, that's a totally different industry. He may very well still get the loan or whatever he's applying for, but all things being equal, if, let's say, Hector worked in construction for 5 years, and now Hector is a civil engineer, and he's been employed with Hug Civil Engineering firm for the last 6 months. Well, he's pretty much been in the construction industry in one fashion or another for 5.5 years. So he's likely going to get a better loan. He also may be making a lot more money than Bob as the math teacher. However, going back to Jan, if Jan had been, say, a waitress for a year, and then Jan went from being a waitress to being a cosmetologist, hairstylist. Just call that hair. And then now she's a office manager. Well, her employment isn't only unsteady in terms of jumping from job to job, but also from industry to industry. So that would also be another check against her, another blackball, or however you want to phrase that. So that is one thing to consider when you're getting credit. You want to look at it not unlike you would getting a job. And as far as credit history, they're looking at largely your credit score, which shouldn't be any surprise if you've heard of the three big credit bureaus, which are Experian, Equifax, and TransUnion. So they will all do a credit score on someone, and then they have various companies out there which will provide you your credit score. Some of them are free because they have an advertising model, or they'll give you credit card offers, which is pretty much advertising. But that's something as you build credit and you actually have a credit history, you want to look at your actual credit score from time to time. You want to make sure you're not getting too many dings on that sum. Every time you apply for a loan, for instance, they'll check your credit, and that can be a ding against you on your credit score as well. So, how often you're applying for credit is also part of your credit history. So, that's something you want to take into consideration is really do your homework, be ready to apply for credit. Don't just look at it as something that, well, you have nothing to lose if you don't get approved. Well, if you don't get approved today because you didn't do your homework to make sure you're in the best position, and say 6 months from now, when you've been at your same employer for a whole year and you're doing well with other metrics like your credit score is starting to go up and so forth. Well, the fact that you had applied for credit in the last 6 months 3 or 4 times may be held against you. And then we have capital cash flow. So capital or cash flow, they're more or less the same idea. And or capacity and cash flow is what that's supposed to be. Sorry. Capacity, cash flow. And they're going to look at measures of liquidity. Liquidity is referring to namely cash, so your ability to repay loans. And they're not just looking at your work history in that case, where you get money from, but specific ratios like your debt to income, for instance, debt, which is a math concept, right? So you take your total debt and divide it by your income. So they'll look at a specific benchmark. They want to make sure that your debt to income ratio isn't above 80%, for instance. That percentage is going to come into play a couple more times, actually. Then we have your capital. So you can think of that as skin in the game. So what we're talking about, let me put this back up. Income. Skin in the game would be how much you're financing the endeavor for. So let's say a mortgage, when you borrow money to buy a house. Well, most mortgage lenders, most mortgage brokers want you to have at least 20% that you've financed the purchase of the loan with. So whatever the total cost of the house that you want to finance the purchase of, if you've put up 20% of that, that's going to help you get a better rate and much of the time increase the odds that you actually get approved. Now, there are exceptions. VA loans don't require any kind of down payment. That's if you've served in the armed forces. A VA loan is a pretty good deal for folks in that camp. And additionally, they are also able to avoid closing costs in most cases. For everyone else, if they are able to get the mortgage, then what it means is their mortgage is going to be more expensive because they're going to be paying something called a PMI insurance. and they're likely going to have a higher rate than they would have had if they had just put up the 20% for the mortgage. And of course, businesses, if you've actually put up your own money towards the business, that's also going to look more favorably as well. So this time around, let's make Jan the person that's done her homework. So she used her savings to start a business. 60% of small businesses were financed with the owner's actual savings. And she's been in business 2 years. So now she just wants to grow her business to get to the next level. And she already financed it on her own from the beginning. She just needs an infusion of cash to, open, say it's a restaurant, and we're not living in the COVID-19 era and restaurants are a thing again. And she wants to open a restaurant in Carson City, and she already has one in Reno. Well, she may be looked at in a more favorable light than, say, Bob. If Bob just, he hasn't put up any money, so this business hasn't even started. We're at zero. And he goes to the bank saying, hey, lend me money. Well, Jan's going to be in a much better position because she already has a business. They can look at not only her business plan, but they can for how she's going to differentiate her business or how she's going to expand upon her business as it exists as far as the brand loyalty and so forth, and extending that same brand from Reno to Carson City. Whereas Bob, he has no business, there's no history to look at, and he's not putting any skin in the game. So not too different from financing the purchase of a house. And then we have conditions. So conditions could boil down to, say, external factors like the economy. So right now would probably be a bad time for a lot of people to get any kind of credit. Not everyone, but all things being equal, when the economy is doing well, lenders are typically more willing to loan money than when the economy is not doing well. Also, a kind of external factor that would be looked at would be use of the money, use of funds. So, for instance, if you're using the money to pay back debt, that'll likely be looked at in a more favorable light by most lenders than if you're just using the money for a vacation fund or to pay for your daughter's wedding or whatever. One use of credit the lenders do really like typically, in my experience when I worked in banking for 8 years, is using the funds to make repairs, improvements on your home. Now, they will then ask you questions about your race, ethnicity, and gender in order to comply with federal guidelines that ensure they're not discriminating against folks. So it can get a little personal once you open that door, but the intended use of the funds, it will also help the underwriter, which is the person approving the loan, not the salesperson at the bank that you're talking to about getting the loan, but the person who decides whether or not the loan is going to be approved really wants to know what you're using the funds for. And then we have collateral. And I think most of you understand what collateral is, but a good example would be in grade school and you want to use the bathroom and the teacher says, give me your pencil before you can go to the bathroom. It's something you're putting up that you're saying, hey, I'm going to come back because I want to get my pencil back, or I'm going to leave my backpack here so you know I'm going to come back. It's collateral. And the same idea when you buy a car. You buy a, this is a terrible car, but if you buy a car or even a house, unless you pay for that house or a car up front where you pay all the cash, you're not financing anything, that house, that car, even a business is a form of collateral, because if you don't pay back the loan, well, the lender can seize the house, seize the car, seize the business. So those are the 5 C's of credit, something you really want to familiarize yourself with as you become adults and go out into the world and start financing things. And another quick rule of thumb too, credit cards can be dangerous. A lot of people get into massive debt with credit cards, but if you're able to manage them well and only use about 80% of the available credit, that's another metric that lenders will look at, and that would fall largely into cash flow along with debt to income. So that's another metric or ratio that the lenders will look at to determine your capacity, your cash flow, your ability to pay back the loan.